Welcome. In this video, I'll be back testing momentum divergence with 3 different risk to reward ratios 100 times. So I'm testing 1-to-1 risk to reward ratio, 1-to-2 risk to reward ratio, 1-to-3, so that we can see what is the best setup for momentum divergence. I'm using a free indicator, Fu Manchu Cipher B plus divergences indicator. I'll show you that in just a sec. But before getting into explaining the exact strategy I'm testing and all the back testing with results, quick shout out to my affiliate BingX Exchange, where you can trade a huge variety of markets, all the way from crypto to stocks, Forex, indices, and commodities. Check out BingX Exchange with my link in the description down below. They have good competitive fees, no KYC, no VPN needed, so anyone can access the exchange. So check it out with my link in the description, and I'd appreciate that. Now let's talk about the exact setup that I'm going to be testing here so you know exactly what I'm giving the results for. Let's start with the one indicator that I'm going to be using to spot these bearish and bullish divergences. That one is the Fu Manchu Cipher B divergences. So you can search it for free on the public library, Fu Manchu Cipher B plus divergences by Fu Manchu here. And all I've done to it is pretty much gotten rid of all the fluff on it. I've just kept the overbought level 2, the oversold level 2, the buy and sell circles so I can see the crosses, and the momentum waves themselves. Okay, so just got rid of everything else. All I need are these momentum waves and the overbought and oversold levels. All right, now the actual setup that I'm going to be taking the entries based on. Let's go over that, as well as stop loss placement and take profit target. Remember, I'm going to be testing 3 different risk to reward ratios. So stop loss will always be the same for all 3, but I'm going to be seeing how many times it goes 1-to-1 risk to reward ratio, how many wins we have with 1-to-2, and how many wins we have with 1-to-3 risk to reward ratio. So here's an example of a trade setup, and it has to be this very specific type of divergence. Okay, so this is for a short setup here. We have a regular bearish divergence. First, we need to see a cross down in the overbought territory here. So it's over this white line. That's the overbought level, 60. So we have a cross down there. Then we need to see another cross that makes a lower high and is under the overbought level. Okay, so this cross, the entry one, cannot be over the 60 line, so it's underneath this overbought level, and at the same time price makes a higher high in between those 2 crosses. So it's going to look just like this: overbought cross down, not overbought cross down, lower high on our momentum, but a higher high created on the price, and wick or no wick, higher high nonetheless is created here. So that's what I'm going based on. The actual entry is the candle close, the cross down here. So you can see the entry would be right here on this candle close. So it would be on this one's open actually. So right here, the stop loss will be placed at the highest point before this cross down that creates the bearish divergence. And as I said earlier, I'm going to be testing a 1-to-1 risk to reward ratio, a 1-to-2 risk to reward ratio, and a 1-to-3 risk to reward ratio. Okay, so I'll give you all the numbers for out of the 100 back tests. What happens with the 1-to-1, what happens with the 1-to-2, what happens with the 1-to-3, what's the best way to go about it? Should we move the stop loss to break even when it goes 1-to-2 and then target 1-to-3? So we'll go over all the numbers for those things after this. Now, just give an example for a long trade so you can see, so it just makes sense to everyone. So what I'm testing, the exact thing I'm testing, and then I'll get into the back testing and the results. Here's an example for a long trade. So here we have a bullish divergence that first crosses up in the oversold territory, then crosses up above the oversold territory. We have a lower low on the price action with a higher low on our momentum. So that's a valid entry upon the candle close that causes this cross up with the bullish divergence. So we can see the opening of the next candle would be the entry price. Stop loss will be placed to the lowest point before this cross up that creates the bullish divergence. And then of course I'll be testing 1-to-1 risk to reward ratio, 1-to-2, and 1-to-3, and given all those numbers. Now this can be disqualified. A setup can be disqualified if we don't have this specific type of divergence setup. For instance, if this were to cross up right here on this green dot, come all the way back up above the 0 line without creating any other crosses, that would disqualify the setup altogether. It needs to be all one momentum wave. I don't want to see it coming up above the 0 line for a buy setup. I don't want to see it coming down below the 0 line for a sell setup. It needs to be all one momentum wave that creates this specific type of divergence setup, okay? So I don't want to see any where it's just a bunch of fumbled crosses or coming up and down over the 0 line. I'm going to reset and look for a new setup. If we have that sort of thing happen, it disqualifies the setup. So this is the specific type clean setup that I'm looking for. Okay, so time to get into fast forwarding through the back tests and then go over all the results. The results are in, and I have a lot of things to cover here. So let's talk about what the best way to trade this momentum divergence is. So as I told you earlier, tested 1-to-1 risk to reward ratio, 1-to-2 risk to reward ratio, and 1-to-3, and then kind of got a bit theoretical over here with how to do this the best way, even moving the stop loss to break even at a certain point, and then also talking about some ways to improve results even more beyond this. So let's just start at the beginning here. This was tested on Bitcoin, 15-minute time frame, and here are the results of a strict 1-to-3 risk to reward ratio. 38 of those trades were winners, 62 were losses. That means risking 1% of the account per trade, not compounding. 52% gain on the account over the series of 100 trades. 1-to-2 results. So 46 winners, 54 losses, gain on the account 38%, again assuming 1% risk, not compounding. Now 1-to-1 results. 61 and 39 losses. So 61% win rate, 1-to-1 still profitable, 22% gain on the account assuming a 1% risk per trade, not compounding. Now, how do we go higher than what we currently have as our highest gain on the account? Theoretically, we move our stop loss to break even. Once price is gone, 1-to-2 risk to reward ratio in our trade's favor, continue targeting the 1-to-3 target, and then the results of it would or should look something like this, where we have 8 break-even trades, 38 winners, and 54 losses. Maybe it's a little worse than this. We don't know, but gain on the account 60%. So again, assuming the 1% risk per trade and not compounding. Remember, this is taking every single divergence setup that meets the criteria that I mentioned at the beginning of the video. So how do we improve results even more beyond just the stop loss break even and risk to reward ratio and the strategy itself? Well, we add additional filters, so we can improve results more by filtering the trades for trend direction. So where do we think this trend is heading? Of course, trading with the trend puts the odds in your favor, more so than just taking trades counter trend and with the trend, and whatever is happening in the market, we just take the trade based on the divergence setup. But wouldn't it be better to trade with the trend and skip out on the trades that go counter trend? So also, taking trades after sweeps on logical levels for stop loss hunts. This includes sweeps on a support or resistance or just a significant level where a lot of stop loss might be resting. So often I would notice losses. They would take a loss and then the trade would go in the original trade's favor right after hitting the stop loss. So not only waiting for a significant level to be swept before taking a divergence setup, but also just messing with how the stop loss is placed in general. So maybe it's better if the stop loss has a little bit of a filter or a little bit of a buffer larger than just right there at the high or low, depending on the trade direction. So quite a few things that we can still mess with this type of thing. But what it does tell us is that no matter how we set it up, even with no filter, it's profitable to trade divergence based on this test. So this test shows that trading with a basic divergence, it does provide a profitable result if you stick to it. So that's what this test shows. It doesn't mean it will always be the case, or that on other samples of price data that is the case, but based on this test, that's what I see. So that's going to conclude it for this video. Hopefully you guys found this one educational and entertaining, and hope you have a great day. Don't forget to hit the like button if you made it this far. Subscribe if you haven't. A lot of people who watch my videos are not subscribed. Comment for the YouTube algorithm. And if you're interested, check out Bing X Exchange, where you can trade plenty of different markets. Whatever you trade, you can trade it there. So Bing X Exchange in my description. Appreciate it. They have a bunch of bonuses there that they're offering for new users. So definitely check it out. Thank you. Have a great day.